What is going on, beautiful people? It's Joe, the Nomad Investor, where dividends freedom anywhere is the goal. And today I'm going to be providing you guys with another portfolio update as usual. And I'm sure you guys have already seen from your own portfolios, if you have one, the market has been down. It's been tanking. It's been kind of a bummer to see, but we are looking like we're going to recover. And I'm going to share why in this video. So, without further ado, if you are new here, make sure to smash that subscribe button. It would mean so much to me. Keep me motivated to continue to make videos like these and more. But most importantly, let's get into the state of affairs. So, we are currently at 441 subscribers and 17 videos released. I'm currently filming the 18th video as we speak. And yeah, I mean, this is my most recent video that I did where I talk about how the market was tanking. And I thought it was bad in that video, but it actually got way worse afterwards. And I'm about to cover that now. But before that, let's get into things. As usual, the videos on this channel are for informational, entertainment, and educational purposes only. I am not a financial professional or advisor, and nothing here should be taken as financial, investment, or tax advice. Investing always carries risk, and those seeking financial advice should seek out a registered professional. Okay? With that being said, if you are new here, this is my game plan and goal for growing a small portfolio from $0 to $1,000 per month in dividend income. If you are already familiar with the channel, you're already a subscriber, you can basically skip past this part to where I go to my portfolio. Anyways, so for those of you who don't know, I have two sources of income. And basically, one is remote work income and the other is business income. Now, my remote work income is consistent and my business income does fluctuate. But basically, I've dedicated to committing a minimum of $300 a month towards contributions. And it could be more, up to almost $1,000 plus, depending on how things go with the business. But basically, I'm going to be depositing that money into my Robinhood taxable brokerage. And I'm going to be treating my brokerage like a business, aiming for 30% plus high yield. Now, I'm going to be investing this money into high yield income ETFs such as WPAY, HOOW, QDTE, XDTE, positions like that. And I did set out to have a max of 3 positions, which I currently still do, but I may possibly look into adding another 1 or maybe 2. So probably a total of 5 positions and then cap it at that for now. But I'm alternating between anchors and satellite ETFs. This is following the core satellite investing strategy. I learned this from a guy by the name of Eugene Vasquez. Really awesome channel that he's got. But yeah, basically I'm going to be taking the dividends that I get paid out, whether that's weekly dividends or monthly dividends, and reinvesting them. Now, I'm either going to do this through dripping, which is dividend reinvestment program, or stacking dividends to purchase when the market is down. I did have someone comment on one of my recent videos on what stacking dividends means. Basically, instead of me automatically reinvesting them right away, I'm kind of just storing them or saving them up for when there's an opportunity to invest. Like, for instance, the market has been really down as of yesterday. So yeah, that would be a perfect time to stack and then invest at the bottoms if you can, or at least DCA down. But basically, drip plus always compounding is the portfolio growth strategy. So that is basically the approach. And then I'm basically going to be rinse and repeating this until the account hits $1,000 a month in dividend income. Now, again, disclaimer, none of this is financial advice. This is strictly for entertainment purposes only. Now, one other thing I did want to share with you guys is this. So I do have these dividend income milestones while I'm growing my small portfolio. That way I can celebrate the small wins leading up to the bigger goal along the way, which is the $1,000 a month. So for those of you who are new, I've already smashed the $100 a month goal, and I'm so close to hitting that $200 a month goal. If you watch my most recent video, I'll tell you how much I actually earned in dividend income this month. We still have 1 more week left where I will get some payments. So we shall see if this is smashed or not, or if we'll even get closer to hitting this. So stay tuned. But with that being said, let's hop over into the portfolio on Robinhood. As you guys can see, we took quite a beating, $104.22. Actually, probably more, but let's just say $104, maybe $105 if I round it up a little bit. In lost. Now, at one point, it was getting pretty bad. And let me turn on the all hours and go to the week. But yeah, we basically were down $348.19 at one point, or 8.76%. And it was just so brutal, guys, honestly. But I'm happy to say that I did end up actually purchasing right around here at, it was actually 10:45, but I can't quite pick this up here. I'll put a screenshot so you guys can see. But I basically purchased around 10:45 on October 22nd, Wednesday, October 22nd. And I thought I thought I bought the bottom. I really did think I bought the bottom, guys. But of course, I didn't. And it kept going down until about $340.72, or 8.6% was down. Now we are seeing a recovery, and there's a reason for that. Trump released some good news, which I'm going to share shortly. But first things first, we are at $3,802.62 as of right now in the portfolio. I already shown you guys how much we're down. As you can see, the buying power has changed. We currently have $1,070.74 in buying power, and that's because my margin usage has increased to $3,234.49. Of course, the cash is zero because I'm using margin, and we are at a 44.56% buffer, and we are $1,694 above our margin buffer, our margin requirement, I believe. So that is the state of things. And then we are down $132.83 on WPAY, $115.53 on HOOW, and $16.39 on NVDW. So NVDW has actually been holding fairly well, which is nice to see. Meanwhile, WPAY and HOOW got a beating. But if we take a look at the growth stocks, I mean, today it's starting, because it's pre-market, today is starting to look a little bit more positive after the Trump news, but it was all red pretty much here, except for, I think, Google. Google was basically the only thing that was in the green yesterday that's on my list, right? But that's that. And then let's hop into each position individually so I can show you guys what's going on here. So our current market value for WPAY, which is currently sitting at $51.30, is $3,645.35. We have a negative total return of 3.52%. Our average cost is 53.17, and we are at 71 shares. So I did increase this by 11 shares. I did buy 11 shares, and our portfolio diversity is 51.80. So real quick, I did want to cover this about WPAY, because I know a lot of people are saying like, oh, it's going to zero or it's dying. But as you can see, at inception, the price was $51.11, and now we are at $51.30. So we are still above the price that it released. And I am going to anticipate and expect that this is actually going to start moving towards the upside again. And again, I'll share with you the news regarding that. But this is my position in WPAY. And just to be fully transparent, here is the 10 shares I purchased at $51.11. That's when it filled. So I actually bought in at the original, if you go back here, the original price when this fund launched. So that's cool to see. And then I did purchase one more share at 50.36, so below launch value. Hopping over to HOOW, it's currently at $64.50 a share, and our market value is $1,999.86. We are down 5.76%. Our average cost is $68.23. I did again buy right around here. Actually, this is when I bought 10:45. I bought some more. But we're at 31 shares, so I did increase as well here by 11 shares. We have 28.42% portfolio diversity. And actually, I didn't buy 10. I bought 9 shares in total. I apologize. But we bought 508 shares at $63.11. And then I did buy one more share at $61.82. And let's hop into NVDW. We are currently at $44.90 a share. My market value is $1,391.90. We are down 1.16%. Our average cost is $45.43, and we are at 31 shares at a 19.78% portfolio diversity. And as you guys can see, I bought 11 shares for this particular position. So we got 10 shares at $44.68, so below the current share price. And then I did purchase another share at $43.94. Now you might be saying, like, why did I end up only buying 1 shares when I bought so much big shares? Well, I didn't want to use all my margin. And to be honest, I kind of aped in all the other positions because I thought we hit the bottom. Instead, I probably should have slowly DCA'd like I usually do. Usually I like to do 2 to 3 shares purchased each time I see the market go below my average cost per share, but I didn't. So it is what it is. And then in terms of the investing journal, I haven't updated this, but I did want to show you guys. So this is what it was at yesterday at pre-market. So at pre-market, we were at $3,865.65. As you can see today, we are at $3,802.62. And then my monthly contributions have not changed this month. So we're still at $2,081.16 for contributions. Obviously, my shares have increased for all these positions, and my margin has really increased a lot because I haven't paid it down yet. But we are at $3,234.49 versus before we were at $1,659.66. And then for those of you who are new, we did receive $196.66 for the month of October so far in dividend payments. Okay, hopping over to the dividend sheet, we can see here that the most important thing I want to pay attention to is the market return and total return. So we are negative on everything, on market return, on total return. And even though this sheet doesn't pull the after hours or pre-market numbers, this is something to consider and know. So yeah, this is the current state. We're negative 5.08% market return on HOW, 3.76% down on WPAY, and 1.47% down on NVDW for the market return. And then for total return, we are at negative 0.81% for HOW, negative 1.2% for WPAY, and negative 0.5% for NVDW. And you might be wondering why the total return is different for the market return. Well, it's simple. We get paid dividends and we reinvest them back into these positions. So that is exactly why the total return is different. That being said, I wanted to quickly share my Twitter with you guys. I did recently just create a Twitter. Feel free to follow me on there. But let's hop into the news. So first things first. So according to what this person commented, Ash Crypto below, he says President Trump says he will make a deal with China on everything. We shall see if that's true. So this is most likely why we started to see the market do some slight recovery, towards here. So that's why we are not at the rock bottom. And I'll just use this as an example. This is why we really started to see that recovery a little bit. We'll see if this continues. I think it will, but only time will tell, right? Anyways, let's get into the next news. So now that that's all said, this is interesting. I actually found this post on Twitter, and it says there's direct ULTY competitors that will be launching very soon. So number one is KYLD by Curve Invest. I believe Curve Invest is managed by the founder and CEO, Howard Chan, if I remember correctly. But it has an effective date of immediately. So it could be launching any day pending certification. The second one is Income Max Option Strategy ETF by Rex Shares, which has a new effective date of 10/29/2025. No ticker has been assigned yet, but again, you can expect it to launch on the 29th. And then there's the third one, which is a Smart Allocation High Income ETF by Tidal Financial Group. And that has a new effective date of 11/14, so November 14, 2025. No ticker has been assigned for that as well. But looks like with this, I think we can say that ULTY is coming to an end. I think it's looking pretty bleak. And not just because of the state of the market, even before the state of the market came to where it's at now, ULTY has just not been recovering whatsoever. And I think the warning signs are there. So yeah, that's what's going on. There's a lot of competition heating up between these hedge funds. And to be honest, they're all doing some pretty unique things, pretty different. Personally, I really enjoy Neos and Roundhill investments. I haven't invested into the other funds, but Tidal and Curve interest me a little bit as well. But I will be keeping out an eye for KYLD and seeing what all that entails. So that's going to be interesting. Just kind of diving a little bit deeper, KYLD, according to High Yield Hustle on Twitter, KYLD is Curve's soon to be released high income ETF. High income is the primary and main objective. Similar to ULTY, it's going to use high volatility stocks with a hedge fund like approach. So the strategy is the prospectus essentially allows them to take any trade they want, from put spreads, callers, to holding the underlying for standard calls. Now, I think this right here is what's making it so competitive against ULTY. Because ULTY is just, if I remember correctly, a covered call ETF. Versus this is kind of covering all your bases, from puts to calls to callers to holding the underlying stock or hold underlying asset for standard calls. So this is really interesting. And then unlike YieldMax, they have the ability to also sell as well if they want to. And what makes this different, Curve has always prided themselves on avoiding NAV erosion. You can see it across their funds. Okay, so this is really good to know. And this leads me to believe they are looking to strike more of a balance with this approach. Instead of 85% yield with nonstop erosion, I believe they'll be aiming for about 50% with much more stability. 50% is good. Anybody who says otherwise just isn't being realistic here. You guys got to remember, in the traditional dividend world, if you're doing anything beyond 10%, you are doing amazing. And it's also not normal. But yeah, anyways, that 85% that we typically see, it's not always going to be that amount. It's always going to fluctuate up and down, as we've seen with even Roundhill's funds. And that's why they've done such a good job, I believe, at avoiding NAV erosion, right? Or NAV decay. It's because they are fluctuating their distribution, their dividend payout. But of course, everyone is entitled to their opinion and their sentiment. But essentially a version of ULTY that exposes you to way less risk. Curve is quietly building out a very impressive track record. KYLD is their first attempt of branching out from their regular strategy. This is one I'll definitely be keeping my eyes on. But yeah, I'm going to be keeping an eye out for KYLD whenever it launches, whenever it releases. But yeah, only time will tell. Last, but definitely not least, I also wanted to cover this. So this is again from High Yield Hustle. It says, know what you're buying. Yield max, lightning emoji. Pro, max yield. Con, heavy upside cap. And this is true. Roundhill, dollars. Pro, no upside cap. Con, higher downside. This is true, and this is exactly why my portfolio is where it's at, because we have that 1.2x exposure. But the beauty of it is when the underlying assets are moving up, so is the single stock ETFs that I invested into, and so is WPAY. A NEOS is an anchor, which is very true. The pro is stable NAV, and the con is lower yields, like I mentioned. And then Curve is a money bag. So you get a blend of higher yield plus stable NAV. Now the con is lower yield than other options. And then Rex is a rocket ship. So pro blend of upside and high yield, con higher downside. So yeah, guys, this is something to consider. These are the differences between these different hedge funds: Yield Max, Roundhill, NEOS, Curve, and Rex. So yeah, I mean, this is all looking good. Something else that I really wanted to reiterate with you guys is the importance of investing into things you have conviction in. When we're getting down to this mark here, where I'm down 8.6%, you have to really look at things and say, what are your high conviction plays? What do you have high conviction in? And be willing to DCA down into increasing more of your position in there and lowering your average cost per share. And as well as you also have to kind of see the warning signs, the hazard signs. And I'm seeing a lot of people on Twitter, on YouTube, and etc., and even on Discord communities express this. There's obviously some funds people have been shilling for so long now, and they've been saying, oh, this is it. We're going to go back up. But even when the markets were going towards the upside, which now it's not, it wasn't going up in price. It was still decaying. It was still going down in value. So why would you not pay attention to the warning signs? Now, again, if you don't care about capital preservation or capital appreciation, by all means, do your thing, right? But if you want capital appreciation, and most importantly, at least capital preservation, make sure you see the warning signs. Make sure you pay close attention to how your ETFs are performing. And most importantly, make sure you understand how the ETF's price works. Now, with that being said, thank you so much, guys, for taking the time to watch the videos. If you haven't already, make sure to smash that like button. And if you are new here and you have watched this full video, subscribe. It would really appreciate it, and it goes a long way. And most importantly, if you have any feedback, comments, suggestions, or you want to even share some ETFs that I should be looking into, comment them down below. And with that being said, until next time, guys, peace.